Good afternoon again, everyone, and welcome back to the first webinar of this year from MSCI Carbon Markets. So for many of you who have been following our webinar since we were Trove Research, thank you so much for your continued support as we transform into MSCI Carbon Markets. For those of you who just joined us for the first time, we host a webinar series on a quarterly basis to review key development in the voluntary carbon markets and share curated insights from our team. And you will hear more about what the MSCI Carbon Markets platform has to offer in a minute. Before we start, I'd like to introduce our speakers today. Today's webinar will be hosted by me, Am Mokasend. We are joined by the founder and former CEO of Trove Research, now the managing director and head of MSCI Carbon Markets, Guy Turner. We are also joined by our head of carbon market analytics, Peter Fagerman, our senior associate, Juana Hernandez and Felix Hart, and our associate analyst, Jamie Lambert and Delphine Stringer. Some basic housekeeping rules before we begin. All attendees will be automatically muted. If you have any question during this presentation, please use the Q&A function at the bottom of your window. The slides from today's webinar, together with the recording of this session, will be published on our website by the end of the week. For the structure of the webinar today, we will start by having a look at some key developments in the VCM in last year, and then we'll look at some key points to explore our main question today, whether this year could be an inflection point for the carbon markets. Following the presentation, we will launch an audience poll, giving you the opportunity to share your thoughts on what the price of carbon credits will be at the end of this year. And then we will wrap up with the webinar, with the Q&A session at the end of the webinar. So now to get started, I will hand over to our heads of carbon markets, Guy Turner, to speak a little bit about our new home at MSCI and what we've been working on in the past few months. Over to you, Guy.
Thanks, Am, and good afternoon, everybody. Good morning, good evening, wherever you are in the world. This is the first, as Am said, this is the first webinar of our series, our quarterly webinar series with our new home at MSCI. And I think the first thing you'll notice is our backgrounds have been transformed from our beloved purple to, I think, a more optimistic green fields and wind farm background. And so I hope that's enjoyable to the viewers. Just also conscious that there may be some people on the call who may not know who MSCI is. It is one of the world's largest suppliers of data to the financial markets. Been in existence over 45 years, over 5,000 employees, 30 locations, and 6,500 clients, and has a very strong pedigree in supporting funds and asset owners through index analysis and data, a range of analytics products, real assets, and for several years now has been the leading provider of ESG data to the financial markets, providing a whole range of screening tools and supporting data. And ourselves, we sit within, and connected to that ESG research business. And sort of that's where the logic of us joining MSCI started. MSCI has a very strong background in climate data and tools, ranging and supporting a number of decisions for investors and corporates, managing transition risk through data on emissions intensity, fossil reserves and revenues, policy analysis, and then also on the tech side, the green opportunities, the transition will throw up opportunities, and we do a lot of modeling and research and data provision around that. Alignment with 1.5 degree pathways through looking at the commitments that organizations are setting, implied temperature rise, and sort of screening tools to help investors sort of make allocation decisions on that. And then finally, physical risk. So climate risk, it presents itself in a number of ways. There is the transition risk as we move away from fossil-based assets to cleaner technologies, but also the very obvious and more immediate physical risk in affecting many different organizations. And my colleagues do some fantastic work providing models and tools to enable investors to understand the scope of those risks that they're exposed to. And overall, the company covers over 18,000 public companies and sovereign bonds, over 4,000 active equity and debt funds, and 1 million real estate properties and 50,000 funds. So we come to a good home, and you will hear a lot more about the synergies and the opportunities that we can bring to the world. For those who don't know carbon markets and MSCI carbon markets and the previous Trove business, we've been in existence for over 3 years. And really, our role is to provide ultimate transparency and predictability on where the global carbon market is and will head. We have launched a whole range of new tools and data products over the last year. We have teams of experts and data databases in policy area, all the credits, projects, and transactions that supply the carbon credits. As you'll hear from our colleagues on this webinar, carbon credit prices, we track that like a hawk, and both at an aggregated level and a project level. We have AI tools that calculate the inferred carbon price of all projects in the market. Climate commitments. This is where we work very closely with our colleagues, looking at the footprint of companies, what they're committing to, and what that will mean for corporate climate action and their use of carbon credits. A big initiative that we launched last year, a new product, was our credit integrity scoring. We score well over 4,500 projects with over 20 different sub-criteria, and that sheds increasingly useful light on how the market is transacting, where preferences are, and how that correlates with prices. And our forecasting team have their own very well developed crystal ball based on a lot of cost modeling and geospatial modeling to look at where the opportunities for reducing carbon most cost effectively outside supply chains lies. And then on the bottom, we have new models and products around carbon dioxide removals, nature-based solutions, CORSIA and the aviation market that we'll hear more about in the call, and a geospatial platform that shows developers where in the world projects can be developed at least cost. So a lot of activity. We've nearly up to 100 staff now, and ready to take on the challenges of the new year. So just very quickly, why are we here? Well, the concern really is around climate change. As you know, this last year was one of the warmest years, if not, so it was the warmest year on record. We are very close to the 1.5 degree threshold above pre-industrial levels already. We have calculated that in 30 months' time, we will be at that limit of 1.5 degrees C and very close to 2 degrees C in 190 months' time. So time is running out, and the carbon markets play an important role in trying to mobilize capital to solve this huge problem. Interestingly, our fire tracking service looks at the risk of fires affecting emission credit issuances from projects around the world. And in spite of this new world that we're in heat, only 13% of carbon projects actually recorded emissions from fires in 2023, which was an increase on previous years, but not as much as you would expect. Part of the reason for that is the location of these projects being in more humid areas where the risk of fire is less. So that is really why we're here, and let's see how we can try and solve this huge problem. So companies are responding to that challenge. We track regularly the number of commitments that companies are making. The number of companies now signing up to SBTI, either having set an approved target at 1.5 degree or 2 degrees, has been increasing, but so is the number of firms looking to set one. In total now, we have nearly 7,000 firms in the SBTI system, roughly half those committed, another half having set their targets. Now, those can be broken down in a number of ways, and if my animation will work. There's a group of those with net zero targets, and within the SBTI framework, some 2,700 companies have either committed to setting one or have set one. Now, those firms range in size, small to large, but together they do cover a large chunk of emissions. So 2.4 gigatons of scope 1, 2, and 3 emissions for those that have set a net zero target under SBTI, and nearly 12 gigatons for firms that are committed to set a net zero target. Now that 12, 14 gigatons is a substantial chunk of the 55 gigatons of global greenhouse gas emissions on an annual basis. If that is achieved, it's a big if, it will make a serious dent in hopefully a dent in world emissions. And that is the challenge for those companies. And we'll look later on in this presentation about the role that carbon credits can perform. But mitigation and reduction is the most important thing in town. Now, if you look beyond the SBTI and net zero, we track within MSCI all listed companies in the world, over 9,500 firms. And as of Q4 last year, some 52% of listed companies had some form of climate target. Of those, 37% had self-declared net zero targets, and 19% had an SBTI approved target. So those numbers have been increasing. You've seen some sort of slight rate of change, sort of not diminishing. The absolute increase is still growing, although at a slower rate, certainly for the non-SBTI companies. But it's an upward trend, and that is quite a powerful trend to look to. And one of the things we do is make sure that those companies are well informed in terms of their options and accessing the carbon market. And I'll hand over to my colleague Jamie, who'll tell you a bit more about what's going on the supply side.
Great, thank you, Guy. And hello, everyone. In 2023, issuances recorded the lowest annual total in 3 years after falling 25% year on year. The slowdown in this credit supply was largely due to nature-based and renewable energy projects issuing their lowest annual amounts in 5 and 4 years, respectively. In contrast, energy efficiency projects issued 63 megatons last year and were the only major project type to increase supply year on year, near doubling 2022 volumes. In the main, this was driven by supply from cookstove projects in particular. Despite current issuances tailing off further this year, potential issuances tracked by our project pipeline has almost doubled in the past 12 months and now stands at over 1 gigaton a year. But back to the credits that have been issued this year. It appears that the credits that were issued have been gradually getting younger or of a more recent relative vintage. The weighted average age of a credit being issued has come down by almost 2.5 years since 2021 to 2.7 years in 2023, with roughly a third of credits issued within 2 years of their claimed emissions reductions occurring. Much of this has been driven by the decrease in credits being issued by older renewable energy projects, as I alluded to on the previous slide. Now, to take a look at the demand for these credits, we saw retirements rallied in Q4, recording the second highest quarter on record, despite a slowdown in corporate activity in mid-year. A momentum that appears to have been carried into the new year, as we have seen 14 megatons of credits retired as of yesterday in January. And this is already the second highest January to date, and may even surpass the 17 megaton mark set in January 2022. Although the final quarter typically sees corporate use spike, 2023 saw 36 megatons of credits retired in December alone, setting a new monthly high, almost 25% above the previous high recorded in December 21. Unprecedented use of RED Plus and non-CO2 gas credits in December contributed almost 2/3 of the month's volume. And in a few minutes, Felix will dive deeper into the firms behind this. We can see that retirements have been relatively flat since 2021, as falls in certain project types like renewable energy and nature restoration have been closely offset by year-on-year growth in RED Plus and non-CO2 gases. Now, if you take a look beneath the chart, here's the total demand for credits, where we include credit cancellations, which refer to credit use in a compliance market, as opposed to voluntary retirements. Total demand here has also been flat. With the further exclusion of retirements for crypto back in 2022 and 2021, we can actually see total demand increasing marginally year on year, growing 2% on 2022. Now, looking at the standards used by retirees, the largest four registries, namely Vera, Gold Standard, ACR, and CAR, continue to dominate the market, providing more than 90% of the credits retired last year. Retirements from these big four registries actually increased last year, up 6%, while in contrast, total retirements across the next 10 most prominent registries fell back slightly last year. This isn't putting off innovation in standard setting, though, with another 20 standards currently in the process of applying for ICROA accreditation. Hopefully, increased competition and specialization among registries will help to drive up their integrity and not simply add to buyer confusion. There remain a relatively large number of legacy projects developed under the Clean Development Mechanism, which was first set up as part of the Kyoto Protocol. Most of these projects are quite old, and many are considered to be relatively low integrity. There was an end of 2023 deadline for these projects to be transferred to operate under Article 6 of the Paris Agreement, for which just over 1,000 projects submitted an application. Our analysis in this webinar broadly focuses only on the CDM projects that have been marked as eligible for use within countries' NDCs under the Paris Agreement, of which there were just 2.8 megatons retired last year. Usage of the remaining CDM credits that are ineligible for countries' NDCs saw a sharp decline last year, down by 2/3 to just 4 megatons. Continuing this theme, let's quickly take a look at the distribution of age across retirements. So first, we can see that in 2023, corporates retired credits that were on average 5 to 6 years old, a metric that has remained fairly stable year on year. And of the 180 million credits retired last year, almost 60% had vintages more recent than 2017. Although the share of older credits continues to account for more than 10% of total credit demand. And in a year of prevalent market scrutiny, although we haven't seen much change in credit age, we have seen a subtle improvement in the integrity of credits being bought. Using our integrity scores of nearly 5,000 projects, we can see a decrease in the proportion of retirements of very low quality credits represented by our D&E ratings, and increase in higher integrity, A or B rated, compared to 2022. It is hard to unpick exact drivers of this at aggregate level, but this in part reflects shift away from project types that are on average lower quality, such as renewable projects. Very highest quality projects, represented by A ratings, remain a low proportion of overall retirements, given only 150 projects are currently rated as an A. I'll now hand over to Felix to take us through the key companies driving this demand.
Thank you, Jamie. So last year, 3/4 of the retirements that Jamie's just been talking about can be attributed to just 4 sectors, based on publicly disclosed retirements from carbon credit registries. The blue text shows the market share last year in terms of volume retired, alongside the change from 2022 in absolute terms. Fossil fuels extended its position at the top of the leaderboard, driven largely by Shell's increased activity. Now on the right of the table, we show the weighted average integrity of credits retired by each sector, using our carbon credit integrity assessments on the balance weighting with scores out of 5. When we look at the average integrity scores, it's encouraging to see that the quality of credits retired increased or stayed the same in all but 3 sectors. And as Jamie was saying on the previous slide, the weighted average integrity score of all retirements jumped up from 2.9 to 3.1 last year. This is all giving a strong signal that buyers are looking for quality. Now let's have a look at some of those retirees and the changing market shape. Firstly, if we just focus on the year-on-year change in publicly disclosed retirements, 13% of 2022 retirements were by companies who totally exited the market last year, i.e. the leavers. In comparison, 20% of 2023 retirements were by companies who did not disclose retiring any credits the year before, i.e. the joiners. And while the market is still dominated by a relatively select few, the concentration of power in the top 10 has reduced from 28 to 23%. Making the market less susceptible to the changing sustainability strategies of a few big hitters. Going back a year, our top 10 disclosed retirees in 2022 were led by Delta Airlines. They were also our largest retiree in 2021 and 2020. Did they make it 4 years in a row? Let's have a look. So 5 dropped out of the top 10, including Delta Airlines, who almost completely exited the market last year, taking about 15 million credits with it. The other 5 stayed in the top 10, with Shell and Volkswagen increasing their retirements last year to take the top 2 spots. On the right, we can also see the volume and type of carbon credits they retired. Last year's top 10 was completed by 3 companies who were in the top 20 previously, and 2 companies who had never before disclosed retiring a carbon credit in any year. So despite some companies stepping back last year, the market can take confidence in the fact that the joiners outweighed the leavers, as well as a greater distribution of retirements outside the top 10. Subscribers have access to all of our carbon credit retiree information to see who has retired what type of credits, when and how many. Aside from traditional carbon credit retirements, another avenue for corporates to take climate action that generated a lot of interest last year is the nascent CDR market. These are high permanence engineered carbon removals such as biochar and direct air capture, and they typically command a higher price than other project types due to their widely accepted higher quality and higher durability. Many CDR transactions are not for registered carbon credits, but are instead direct agreements between buyer and seller without third-party certification. So tracking transactions therefore allows us to see the types of CDR projects receiving investment on the left chart, as well as the transaction type on the right. Our recently released CDR tracker contains all this information, including the buyers and sellers in each transaction and the price paid. Last year, the number of transactions fell slightly year on year, but we can see by the right-hand chart that the quantity of credits represented by those transactions rose significantly to 5.4 million. And looking at transaction types, I think it's notable that last year a much greater proportion of CDR transactions were as part of a forward offtake agreement, the dark purple bar, rather than a non-binding memorandum of understanding, the black bar we see in 2022. So it's clear that interest and investment in CDR is increasing, and we expect this trend to continue, with demand signals often existing outside of the established registries. Having looked at retirements and CDR in depth, I next want to look at the market surplus. We define the surplus as the difference between the number of credits issued and those that have been retired or cancelled, thereby showing us the credits available on the market. Market surplus has increased over time as credit issuances have exceeded retirements and reached 922 million by the end of last year, which is an increase of 10% year on year. But that's not the full story, as we see on the next slide that the pace of surplus growth is slowing, particularly in Q3 and Q4. And if we break out the nature-based credits, shown in green, we see that the surplus actually shrunk for those credit types in Q3 and Q4, as a large volume of Red Plus credits in particular were retired. The surplus change in all other project types completes the picture, with the pink energy efficiency credits seeing the greatest surplus growth last year, driven by the large number of issuances that Jamie covered earlier. Of course, surplus at an aggregated project type level is only part of the story. Factors such as vintage year, project start date, and project country can help explain why some credits remain in the surplus while some are retired. On our platform, users have the ability to dig deeper into all those factors and more to get a better understanding of supply and demand. So now I'll hand over to Peter to talk about the all-important pricing data.
In summary, weaker price trends across the carbon credit market in 2022 and earlier in 23 largely continued into the fourth quarter. This can be seen in the graph, which shows the volume weighted average by month at the aggregate level for all reported prices. The declining trend in 2022 was sustained into the first half of 23, although relatively stable at an average of $6.60, but then dropped 23% in Q3 to $5.20 and another 7% in Q4 to $4.90. On the next slide, ignoring volumes and just looking at the unweighted or simple averages, the price level was higher last year by a little over $1, although with the same pattern, stable in the first half at $7.60, but weaker in the second half at $6.40. Consequently, based on the average price over the course of the year, the market was only 16% lower in 2022 compared to 23 versus 28% on a volume-weighted basis. In the next slide, we show the price data by project type for last year. As you can see in the quarterly numbers on the right-hand side of the slide, All of the project types were lower in Q4. This resulted in full year price declines as well for each project type, with RED+, energy efficiency, and renewable energy all down approximately 55%, nature restoration lower by 27%, and non-CO2 gas by 13%. The paths over the year, and in particular recent trends, were a bit more mixed. Nature restoration, the light green line, which hit lows for the year in October at approximately $7.40, subsequently staged a recovery to $11.90 in December, which in fact has continued into January, averaging $13.50 in the first 2 weeks of the new year. This recovery was largely off the back of a number of stronger North American IFM prices averaging $20 and ARR prices averaging $10. A somewhat bullish signal is that this rally occurred on heavy volume, particularly in December, where we saw highs for the year in both ARR and IFM. At the other end of the price distribution is renewable energy, the gray line, which has been steadily declining from over $4 at the beginning of last year, but flattened out in the last 3 months, bouncing around $2 on increasingly lighter volume. Energy efficiency, the pink line, and RED+, the bright green line, which were both subject to increased media and academic scrutiny early in the year, also sustained weaker prices, but with some intermittent recoveries. Both fell from their highs in January over $10 to approximately the same levels around $6.30 in Q2, then staged a recovery to $9.25 for energy efficiency and $7.25 for RED+ in Q3, but once again sold off in Q4, ending the year again at basically the same level, around $4.65. Like with nature restoration, this sell-off occurred on very heavy volume, particularly energy efficiency, where we observed highs for the year and activity throughout the fourth quarter, especially in December. Non-CO2 gases, the purple line, are the most volatile on a week-to-week basis among all of the project types reported to MSCI carbon markets. After starting the year at $5.28, the monthly average cycle between lows of $3 to $4 and highs of $6 to $7 in the first 9 months of the year. This pattern continued in the fourth quarter, where after hitting a $1.99 low for the year in October, prices rebounded to an average of $4.35 in the last 2 months, which was in fact just about the average for the year. One interesting aspect of this graph is the distribution of prices at the end of the year. Typically, there is a fair amount of dispersion in prices between project types. This would be very clear in a time series of weekly data, but is also somewhat in evidence here with just monthly data. However, in the last 2 months, outside of nature restoration, which ended the year at its typical premium to the market, and renewable energy, which was at its typical discount, the other 3 project types, RED+, energy efficiency, and non-CO2 gas, converged around the same price level at $4.65 by the end of the year, suggesting the market is not distinguishing between these project types, which could possibly be a sign of the weak market environment. It's important to note that these prices are at the aggregate level and don't take into account the heterogeneity of projects, even within a given project type, or other drivers such as vintage, registry, regions, transaction size, co-benefits, etc., with each of which can have a material effect on individual prices. There's not enough time in this webinar to show price dynamics based on these factors. However, we did want to show the impact of one factor which will assuredly become increasingly critical on a systematic basis as the carbon credit market matures: the environmental integrity or quality of a project. Given the breadth and depth of the MSCI carbon market ratings of nearly 5,000 projects across all project types, we mapped the ratings to our price data to see if there was any structure to credit prices consistent with perceived quality, at least as reflected in our ratings. This slide shows unweighted monthly average prices grouped into 3 broad categories of the MSCI carbon market ratings: high, medium, and low. Even though, again, at an aggregate market level, in other words, without accounting for other price factors, we found it extremely interesting to observe that higher rated credits were priced at a positive spread to lower rated credits on a consistent basis for almost all of the period between 2022 and 23. High quality credits were on average priced $2 higher than medium quality credits, which were on average $3.20 above low quality credits. As you can see on the right, there is some convergence in the last few months between lower and medium quality credits. This is partly due to a rise in prices for a number of low quality nature restoration credits in terms of the prices, and as well, some small size REDD+ credits, but perhaps also suggests that the market may not be distinguishing quality for low and medium rated credits in a weak price environment. And finally, on the last slide, we show the value of the primary market based on retirement volumes dropped by 23% from nearly 1.5 billion in 2022 to 1.1 billion last year. Mainly, of course, due to the decline in prices as retirement volumes in total were relatively flat. And now I will ask you to welcome my colleague Delphine, who will review main policy developments.
Thanks, Peter. Hi, everyone. There were several important policy developments in 2023. In terms of headwinds, there have been important developments on what companies can and cannot publicly claim in the eyes of some regulators. In September, the European Parliament and Commission reached an initial agreement that would amend EU consumer protection rules to prohibit carbon neutral claims based on the use of carbon credits. Claims such as carbon neutral and reduced climate impact would be banned if they're based on carbon offsetting. However, it does not ban the use of credits as such or prohibit advertising investments in carbon credit projects, providing these aren't misleading. Last week, MEPs voted to adopt this directive, but it still needs approval from the Council of Ministers before it becomes law. There's not been much detail on the claims that companies can make as of yet, but the Green Claims Directive, due to be voted on in March 24, could provide clarity on what claims can be made. Whilst we see a shift towards regulation of claims, it does open up the floor to alternative claims, such as that under the VCMI. Its claims code aims to help companies to make credible claims on the use of credits. To make a claim, companies must meet 4 foundational criteria, then select a claim to make, be it platinum, gold, or silver, and retire CCP-eligible credits in accordance with the claim. These claims relate to firms achieving their net zero pathway and compensating a portion of their residual emissions. The percentages for gold and silver were adjusted by the VCMI in the fourth quarter of 23, from 60 to 50 and from 20 to 10, respectively. Companies must then report credit use and undergo third-party verification. In November 23, the VCMI also published additional claims guidance, which included a Scope 3 flexibility claim, similar to the bronze claim that we saw in the original draft guidance. It allows up to 50% of a company's unabated Scope 3 emissions to be met with credits. The Scope 3 claim could provide an on-ramp for companies that may struggle to meet the VCMI's criteria. However, others say that for making flexibility claims, conditions for making flexibility claims are too lenient and the timeframe for their retirement too long. An updated version of the guidance is due to be published in the second quarter of this year. On to the next slide. In terms of crosswinds, most regulations are well-intentioned, aiming to improve transparency, liquidity, and integrity of carbon trading and the underlying credits. In the interim, this may cause some turbulence as market participants navigate the new requirements, but in the longer term, greater regulation should improve clarity in the VCM, promoting growth and scalability. In terms of taxes and benefit sharing arrangements, several countries, including Zimbabwe, Colombia, and Mexico, proposed or announced regulations. Zimbabwe's regulation is particularly stringent as it requires developers to pay a 30% levy on project revenue. Whilst the aim of the regulation is to help the market, in the near term, we think this may cause some disruption. In terms of tailwinds, countries including Indonesia and Malaysia propose voluntary carbon trading platforms, which would be open to international buyers and sellers. In Singapore, companies can now use international carbon credits for up to 5% of their carbon tax obligations. This will likely increase demand for voluntary credits. On accounting and disclosure, the TCFD has served its purpose and has now been disbanded. Its reporting framework has been incorporated into the ISSB standard, which many regulators will use to adopt requirements for companies to report climate risk and risk management. Since the TCFD launched in 2017, disclosure standards for companies to disclose climate risk and risk management strategies have evolved. They are providing clearer guidance for how companies should disclose credit retirement and use towards targets. On quality, in July, the ICVCM published its category level assessment framework for the core carbon principles, including criteria for additionality and permanence. So it's now moving towards its implementation phase. It's being used by category and multi-stakeholder working groups to assess the categories of carbon credits. The category working group will decide which categories will be fast-tracked for CCP labels and which need further assessment by the multi-stakeholder groups. Now over to our international policy expert, Juana.
2023 ended with important achievements in COP28 in Dubai, such as the mention of the need to transition away from fossil fuels in the final text, commitments to accelerating investments in renewable energy, and reducing methane emissions. In parallel, carbon markets found their footing in spite of the failed negotiations on Article 6. Several joint initiatives announced aim to unlock capital and promote scale and integrity for the market. The US State Department, the Rockefeller Foundation, and the Bezos Earth Fund launched the framework for the Energy Transition Accelerator and announced it is planned to be up and running by April this year. The ETA aims to harness carbon markets to accelerate fossil fuel phase out in developing countries. 6 organizations across the voluntary carbon market ecosystem, including the Integrity Council for the Voluntary Carbon Market and the Voluntary Carbon Markets Integrity Initiative, announced they plan to establish an end-to-end integrity framework for the procurement and use of high-integrity carbon credits. This aims to harmonize their existing guidance. Additionally, 6 of the largest carbon crediting programs announced a collaboration to establish shared principles for quantifying and accounting for emissions reductions and removals. This collaboration among standards signals an effort to enhance consistency and transparency with the aim of increasing confidence in carbon markets. On the other hand, the agreement reached at COP28 failed to include the most important steps for operationalizing a new international carbon market under the Paris Agreement. The main disagreements on both Article 6.2 cooperative approach and the 6.4 governed UNFCCC mechanism centered around integrity concerns. On Article 6.2, the EU proposed introducing more UNFCCC oversight on the credits used for bilateral trading. For example, by aligning accepted methodologies with the 6.4 mechanism. This was opposed by the US, UK, and others. Article 6.2 is already operational from what was agreed on Sharm el-Sheikh, but there are still uncertainties around issues such as revoking authorizations and if proposals like the one from the EU could be revised during the next COP. Therefore, Article 6.2 transactions proceed, but with caution. From the Paris Agreement crediting mechanism laid out in Article 6.4, this agreement centered around the supervisory body's recommendation on the methodology assessment, for example, baseline safeguards, and additional requirements for removals. The technical work is expected to continue in 2024, and discussions will roll over to COP29. The 2 key meetings to watch for on Article 6 developments are the Article 6.4 Supervisory Body meeting happening in February and the pre-COP discussions at the Bonn conference at the beginning of June. The good news is that these issues mirror those in the VCM, where many have been working hard to resolve them for several years. To close on Article 6, here's an overview from our Article 6 transactions tracker. As you can see in the chart, Article 6.2 deals continue to advance at a steady pace. By the end of the year, we also saw the first transaction of authorized international transfer mitigation outcomes, commonly known as ITMOs. Almost 2,000 ITMOs were transferred from Thailand to Switzerland and are planned to be used to fulfill compensations obligations under the Swiss CO2 Act. Integrity concerns on Article 6.2 are increasing. In the absence of a final rulebook, participating countries should ensure that their actions stand up to international scrutiny and could pass future tests of high integrity. Additionally, the lack of agreements on Article 6.4 is not stopping VCM preparations. Vera and Gold Standard are now tagging projects that have been authorized by the host country to be correspondingly adjusted. The main application of corresponding adjustments in the near term is expected to be for international aviation under CORSIA, where the first compliance period is scheduled to begin in 2024. Back to you, Guy.
Thanks, Juana, and Delphine. So we titled this talk as "Could we be at an inflection point in the market in 2024?" I think the truth is that there could be a number of inflection points that will change the direction of the market during the year. 2023 was a very interesting year. There was a lot of turbulence. The media spotlight on the market had a profound effect, and Peter showed the effect on prices. Volumes, Jamie mentioned, highlighted the continued appetite for corporates to use carbon credits for various purposes, but Peter showed the effect that I think a lot of that media scrutiny had on prices. So looking forwards, we see 5 key points that could affect the direction of the market in the following year. The first, which has been alluded to by Juana and Delphine, is potential new sources of demand. CORSIA, the International Aviation Scheme, really sort of kicks off this year. It was the first year under phase 1, 126 countries, and we calculate potentially needing up to 200 million tons of credits. The point's been made on the VCMI, and companies are already starting to trial those new claims codes. The Science Based Targets Initiative has been working on its beyond value chain mitigation guidance, and more compliance markets are likely to sort of see the light of day this year. As was mentioned earlier, Singapore, 5% of the carbon tax can be offset this year with use of carbon credits. Mexico starts its cap and trade scheme this year, and the EU has passed rules on carbon dioxide removal certification scheme, which should give support and investment opportunities for the removal space in Europe. European Union is also looking at an industrial carbon management strategy to support carbon capture and storage as part of a much broader sort of decarbonisation strategy in the industrial sector. So a number of sort of pockets of demand bubbling up. The second is the quality initiatives that have been alluded to before. They're moving from planning into implementation during the year. So the Integrity Council, CCP, will become eligible in first half of this year. VCMI finalizing its guidance. Vera and Gold Standard updating their governance and methodologies. The Red Plus, new Red Plus methodology, which was published in Q4 last year, and will start to be rolled out this year and then applied retrospectively to existing projects. And again, as been mentioned, the collaboration between some of the major organizations designing the frameworks for what good quality looks like. All of this year is sort of characterized by an implementation emphasis. We've been talking ever since COP26. You know, there's been a lot of talk. Now, I think we're going to be moving into action. The third sort of inflection point that we characterize is the growth in jurisdictional approaches. Vera's consolidated RED methodology is now sort of being implemented across the world. There are 20 jurisdictional programs across five continents. There's the tropical forest credit integrity guidelines, which is supporting a number of initiatives in developing countries. The energy transition work, the ETA that was mentioned earlier, launches in April this year, supported by some very wealthy benefactors. It was announced in COP27, but it's taken a number of years to take root. Chile, Dominican Republic, and Nigeria are all going to pilot ETA credits in 2024. But the key thing about jurisdictional approaches is their size. If these projects and programs can be implemented at national scale, they have to be sort of matched on demand and supply. You know, one of the pivot points could be where governments sort of on the supply side want to engage in transformational projects, and then they need to find the buyers. Now, I think it's a question mark whether those will be funded directly by donor governments or donor institutions, and how much will be taken up by the corporate sector, and how that affects demand for project-based credits in the conventional carbon market. There is growing interest in soil and blue carbon at a jurisdictional level. The World Bank Engagement Roadmap highlighted this, and you have a number of countries sort of trialing and looking to participate in this on the supply side: Bahamas, Antigua, Oman, all wanting to sort of take it forwards. So some really interesting developments there. Increasing clarity for corporates and claims and disclosures. This was mentioned throughout the talk so far. What you can see is a number of the leading authorities making progress and cementing disclosure requirements. So the ISSB has really sort of clarified that. The EU, UK, Australia, and Singapore all working towards greater transparency on disclosure. What is more equivocal is the second column on the right. This is the claims guidance. The EU and the UK are perhaps leading thinking on this. The UK Advertising Standards Authority and the EU consumer protection laws sort of taking center stage, but the US, Australia, and Singapore not far behind, and we will look to see where those come out. As Delphine mentioned, the UK laws are really designed to sort of protect consumers and not get in the way of companies doing the right thing. And I think that's been sort of mischaracterized in some media reporting. So there's some, whichever way those land, I think is going to be important to keep on top of. And our policy team do a great job in making sure that all of our clients are fully aware of the implications of those developments. The final one, which is sort of a bit vaguer, but is sort of difficult to ignore, is the geopolitical landscape that we're going to be faced with in 2024. More than half the world's GDP is under an election cycle this year. More human beings will vote in democratic elections this year than in any year in the world's history. What will that mean? I think it can be interpreted in a number of ways. You actually sort of combine that with some populist movements in certain countries like the US. There could be, in certain scenarios, a change in how environmental and climate sort of priorities are seen by governments. That could sort of paradoxically open the door for more corporate action. If governments change the role that, you know, that the intentions of the state to deal with climate, and the climate continues to go to need addressing, which it does, then the responsibility perhaps falls more on investors and corporates to pick up the baton. And as was said earlier, the fallout of the lack of agreement on Article 6 sort of puts the ball back in the court of the voluntary market and all the great work that the institutions have been doing behind the scenes for several years now to try and thrash through the technicalities of how we define a credit, make sure it's high quality, and present it to the corporate so they can be confident in using it and making the appropriate claims. So a mixed picture on the geopolitical front, but something definitely to be aware of. So the final piece of this webinar is around where do we think prices are going to be, and we'll open the poll up for our usual Vox Pop. But just quickly, where did we end up compared to where we thought we end up? Well, 2023 was sort of characterized throughout the year as I think of one of optimism, and you can see the price, the probability, the sort of like the distributions of prices for the different project types: renewable energy, clean cooking, REDD+, and nature restoration. And then the turquoise lines at the end about where the year ended up. So renewable energy credits, as Peter showed, sort of hitting a $2 average, but there was some optimism earlier in the year that prices would be considerably higher. Clean cooking, similarly on the left-hand side. Red plus, sort of, yes, in the bottom quartile of expectations. But nature restoration, again, as Peter showed, really showing the value of the voluntary market in attracting capital to sort of higher value projects, but perhaps other mechanisms, government regulation or pure sort of conventional project finance in the private markets cannot do. So one of I think this is sort of very characteristic of the nature restoration in the CDR market in terms of sources of capital. So that's where we ended up last year. Let's, if I hand over to Am, do you want to take control on this one now?
Yes, thank you, guys. So I will now launch the poll so that you can chip in and tell us what do you think, what is the price of the carbon credits will be for different types of the credits. So there should be a poll launching in front of your screen right now. You need to scroll through to see there are 4 credit types. So what do you think the price will be at the end of this year?
Right, we can see the results being coming in, and we'll see what people think. Okay, nature restoration. Again, nature restoration looking pretty bullish.
We'll give it a few more minutes for you to give it a thought and share with us.
Yeah, and I think, the point that I made earlier about what can the voluntary carbon market do that other routes to finance can't is sort of really where you see the pockets of value. So renewable energy has a significant other, particularly grid-connected renewable energy, wind and solar, hydro. They have, substantial sources of lines of capital to support those projects. Energy efficiency as well, with the exception of like maybe cook stoves, pure energy efficiency, buildings, transport, industrial energy efficiency. There are other mechanisms available to support those. So if there is a differential in price, I really think it does focus the mind of the market on what is it that this market is good at and where does it add value.
Yeah. So while we're gonna end the poll, and I think as we're working on our team working on sharing the result, maybe we can go to some of the questions submitted by the audience today, Guy. There's one of the very controversial question you probably hear all the time is that, what is your thought on if the market will punish companies that buying offsets but doing very little in terms of when it's come to their carbon emissions? They're doing very little work, but they're buying a lot of offsets. So do you think the market will punish this kind of company? What is your thought on this?
I think it depends. I don't, if I characterize 2 potential sort of corporates, one where, they're not making an effort to reduce emissions and they've tried to sort of source perhaps low integrity credits, then I think that company could end up for, being scrutinized. Another company showing and demonstrably showing it's on track with its, scope 1 and 2 and hopefully scope 3 emissions. And in addition to that is using sort of high quality carbon credits. That company should be applauded for doing both, reducing emissions. And in fact, the research that we published last year that showed that the companies using carbon credits were also on average decarbonizing quicker, showed that is possible. I think that everyone hopes that is the route that the majority of companies will take. But we will be launching more tools this year to help unpick which companies are walking the talk and which companies are just talking the talk.
Great. Thank you so much. So maybe one more question from the audience before we take
Go
a
ahead.
look?
Yeah, sure.
Yes. So this could probably be Jamie. So Jamie, there's a question about what's the outlook for issuance next year? Do you expect them to grow again? So issuance.
Sure. Yeah, thank you. Great question. So as I shared earlier, issuance have been coming down year on year. This year driven largely by fewer issuances from nature-based renewable projects. However, I think we expect supply from nature projects probably to pick up again in the near future as potential issuances of this project type, which are projects that are pursuing registration. So those are in the pipeline currently. They can't issue yet, but that capacity has doubled in the past year, demonstrating that there's still clear activity going on upstream between developers and investors. And in fact, we saw this exact thing happen in the supply from energy efficiency projects. I mentioned that they've doubled this year. And if we look back at the pipeline in 2022, this tripled in terms of energy efficiency credit capacity. So we saw those then come out with much higher issuances after. So although they are tailing off at the moment in terms of supply, I think the growth in the pipeline and further upstream is still really strong. I think also, just to add a little bit more on the nature side of it as well, we've started tracking the jurisdictional RED programs that are part of ArcTrees. And with their kind of broad geographical scope, we expect that there'll be quite enormous potential coming from those somewhere down the line. And we're currently modeling kind of the projected issuances from those, and we'll hopefully be sharing that analysis from those models to subscribers soon. And just finally, to add to that as well, I think when it comes to issuances and supply, it's worth considering all of the factors that are at play here. Like you have price is a huge one. And then also remember, this is really in the hands of developers at the end of the day when these issuances occur. And we also still have quite a significant surplus due to supply dwarfing demand for the last few years as well. So I think supply will probably pick up again, but the timing of which is very much in the balance. So keep an eye on it, and we'll continue to share that with subscribers in our monthly and webinars with everyone else.
Thank you very much, Jamie. So now let's having a look of the result from the poll.
So we've got results in at $2. Renewable energy really just picking up. I think the year-end position at about $2, 70% plus. A little, and then there's like a little pocket between 7 and 10. Maybe that's for a certain sort of project type. But from renewable energy, bear in mind that the standards of Vera and Gold Standard now, the methodologies say that that we're all in except least developed countries, new projects of renewable energy projects, shouldn't be eligible for carbon credit. So that's probably sort of reflective of that new position. Clean cooking, there are some down at $0 to $3, 7 to 10, 14. The 5.1 where we ended up last week actually looks like some arithmetic mean of the clean cooking distribution. So maybe again, there's still some optimists out there, but again, there's probably pockets of certain types of projects. Red Plus ended up 5.7 last year. There's some some pessimists at 0 to 3, but again, a good sort of 50% of the market thinks that Red Plus could be above $7 on average, maybe around sort of where it is, but probably some room for improvement if those baselines and the integrity assessment work that organizations like ourselves do, I think, comes through. It could sort of drive a separation between the 0 to 3 price points and those that command a much higher price. And nature restoration, a pretty good distribution around 11 to 14. So potentially some uplift from the year-end point at $10. Sort of 75% of people on this call think that nature restoration should be higher than $10 where it ended last year. So I think this maybe talks to some degree to Peter's point about the fragmentation of the market, and these these 4 categories that we ask on are really very aggregated and hide a much sort of broader dispersion in terms of project type and location. But it is, it's the simple way of presenting it at this time. So I think that to me says the market is more optimistic in 2024 than where it ended in 2023.
Would you like to go over a little bit of what we're looking for to launch new feature by the end of this quarter for the MSCI Carbon Markets platform?
Yeah, absolutely. And thank you all for staying with us. We've got a lot of things coming out in the next month. We're going to be launching the CORSIA and aviation module, as we highlighted. That's a sort of core sort of new source of demand and particularly problematic for a lot of airlines. A new Article 6 price forecast. So we touched on corresponding adjustments, but how much will they cost? Who's going to price those when the market isn't trading liquidly at the moment? Well, we're issuing a very complex, comprehensive model that will sort of show which how the prices that countries and those looking to secure corresponding adjustments should be looking to pay for those credits. The addition of AQs, Australia Carbon Credit Units, is being added to the platform. And we are going to be launching our geospatial cookstove development model, which will show at a very granular level the areas of countries which are most appropriate to develop those projects, and a lot more. We will have more webinars end of January, which is for clients. We've got a nature-based solutions webinar in February, March, and April. We will be covering CDR market with a view to looking at biochar, REDD+, and then our next quarterly webinar in review. So lots happening on our front, and more to come. On that basis, I bid you a great 2024, and we have a lot of work to do.
Thank you. And so exciting year for the carbon markets and for the MSCI Carbon Markets platform as well. All the slides and recording from this webinar will be available on our website by the end of the week. And please follow us on LinkedIn and sign up to our newsletter so that you get notification and get up to date about our next event. Until we meet you again at the next webinar, thank you so much for joining us today. Thank you.